Welcome to the Market Recap. In today's episode, Federal Reserve considers closing bank loophole, Biden begins 6G wireless communication talks, and lastly, new ETF focuses on cleaning up the environment. Federal Reserve considers closing bank loophole. The Federal Reserve is considering closing a loophole that allows some mid-sized banks to boost the amount of capital they report for regulatory purposes. This exemption was granted in 2019 to banks with assets between $100 billion and $250 billion, including Silicon Valley Bank, SVB, and allows them to use a simpler method to calculate their capital ratios, potentially inflating their capital levels by excluding some losses on securities they hold. SVB, which had $200 billion in assets, collapsed in March after suffering heavy losses on its securities portfolio, consisting of risky bets on technology stocks and cryptocurrencies. The bank's capital ratio, which was reported as 9.5% at the end of 2022, was actually negative 3.4% when calculated using the stricter method. The loophole was a contributing factor in the collapse of SVB, which was the largest U.S. bank failure since the 2008 financial crisis. Biden begins 6G wireless communication talks. The Biden administration is taking steps to prioritize the development of 6G wireless telecommunication and catch up to countries like China that have already made significant progress in 5G deployment and innovation. This could have significant implications for the future of cloud computing and the mobile internet. 6G will theoretically provide higher frequencies, higher capacity, and 1 microsecond latency communications. 6G might roll out around 2030 or earlier. New ETF focuses on cleaning up the environment. The recent launch of USCA by DWS. This ETF tracks the performance of U.S. companies that are leading their industries in making positive impacts on climate change. It uses the MSCI USA Climate Action Index, which measures the level of emissions of each company and ranks them within their sector. The companies that perform the worst in terms of emissions are excluded from the index. The index also follows the Greenhouse Gas Protocol's corporate standard, which classifies a company's greenhouse gas emissions into 3 categories. The hardest category to track and manage is Scope 3. This means that the ETF focuses on companies that are doing the most to reduce their carbon footprint. However, the article also highlights that the ETF may face regulatory uncertainty due to SEC Chair Gary Gensler's push for public companies to disclose their exposure to climate change risks. This push is facing opposition from lawmakers and organizations threatening lawsuits if the disclosure is finalized. Thanks for watching and have a nice day. Hit like, subscribe and ring the bell for more content like this.